Day two, we're going to actually start out with a YouTube video. It's a 40-minute video. I am sorry to say it's not all that exciting, but it does give very good background and insight kind of into the monetary system as a whole and the Federal Reserve, which is kind of what we'll be talking about today. So yeah, after that, we'll have a short little lecture after the end of this video and wrap it up pretty quick. Have a good day. So if you don't mind, go ahead and start in that. Sorry.
Is this saying like 05?
Oh, probably way earlier.
So it's back in like elementary.
The Federal Reserve System virtually controls the nation's monetary system. Yet it is accountable to no one. It has no budget, it is subject to no audit, and no congressional committee knows of or can truly supervise its operations. These are the words of the late Professor Murray N. Rothbard, economist and academic of the Ludwig Mises Institute. The Institute is dedicated to the ideals of a free market and sound government. This program is dedicated to the members of Murray and Rothbard and his prolific work on money and banking.
Yeah, individually, for some reason.
For more than 20 years, the living standards of middle-class Americans have steadily declined. Incomes have remained flat or fallen, and the opportunities and security we once took for granted have begun to fade. For most families, one income no longer pays the bills. It requires two or more incomes to afford a home, pay medical and child care expenses, and put children through school. Unless present trends change, young workers are unlikely to ever live as well as their parents. Good jobs with a future are harder to come by. Education doesn't count for what it once did. Taxes continue to rise, while Social Security is going bankrupt. Private pensions are no longer reliable. Economic volatility and uncertainty are on the rise. Politicians espouse numerous theories about the cause of this country's economic woes. Seldom, however, do these officials look below the surface. The roots of our economic ills can be traced to central banking and our present monetary system. The Federal Reserve claims to manage our money. Instead, it makes our money worth less and less every day. It has generated continuous and worsening business cycles and lowered our living standards.
It's really no different from a burglar in your house wanting to steal your money. That's what the Federal Reserve does. It depreciates your savings, it takes away your economic security, and it ought to be treated as an institution that does that rather than something of a much benefit.
Money is supposed to serve as a reliable standard of economic value, not a source of instability. Until we restore sound money and take away the government's ability to debase it, we have little hope of restoring the freedom and prosperity that made America great.
And we really have a choice on what we want in money. Do we want money that's going to be losing its value every year, or do we want money that's going to be gaining in value? If you are happy with your money losing value, then you want the present system. If you want money to increase in value, then you want a gold standard.
What is money? As the good that makes exchange possible, it's the foundation of every economic activity. In the earliest times, people traded goods and services directly. This form of exchange is known as barter.
That is, if a fishing tribe desired to have maybe wheat, which they themselves did not produce, they would seek out other individuals that produced wheat, and then they would exchange theirs for fish.
But barter had limitations in the marketplace.
Well, actually, people perceived pretty quickly problems with that direct exchange. If you wanted, for example, fish, and you had wheat, but people who had fish didn't desire the wheat, you were stuck. Okay? Unless you went out and found some other good, possibly berries, that everyone in that society consumed. Then you would trade your wheat for the berries, in full confidence then that you could turn around and trade the berries for the fish or anything else that you desired.
Eventually, the most widely accepted goods in a society became valued for their use in indirect exchange. Money is simply another name for the most generally accepted medium of exchange. Throughout history, many goods have served as money. Feathers from the Quetzal bird were used for exchange by the Mayan Indians up to the 15th century in Central America. Tea leaves compressed into bricks were traded in East Asia through the 1800s. Wampum shells were money to North American Indians, while early American colonists traded beaver pelts, which had a high value both at home and abroad. Metal coins first emerged in Greece and Asia Minor during the 7th century BC. Gold and silver were valued for their use in beauty and jewelry and the decorative arts. They were durable, easily divisible, and limited in supply. These precious metals also had a high value-to-weight ratio, making them easily transportable.
You might think back, or we can think back to a time when iron was used as money, for example, in Africa. But imagine going into Sears Roebuck and trying to purchase, let's say, a lawnmower for $350. That would take a ton of iron, whereas it would only take an ounce of gold.
In 1536, less than 50 years after Christopher Columbus set foot on American soil, a Spanish mint in Mexico City struck the first coins made in the New World. These silver coins eventually found their way into the British colonies. Great Britain's mercantilist policies deliberately tried to keep precious metals out of America, so the Spanish milled dollar became the unofficial currency. It was often divided into 8 pieces for smaller transactions, hence the term pieces of 8, with 1/4 of the coin being 2 bits. In 1792, Thomas Jefferson adopted the dollar as this country's official monetary unit.
He looked around and investigated to see what were the American people using, and that was the dollar. And so that's why that dollar became the standard of the United States. And we went on to the gold and silver standard and started making gold coins into American people. And then
Jefferson, in particular, spoke eloquently of the dangers of paper money. During the War for Independence, the Continental Congress printed vast sums of paper money out of thin air to finance the Army. The diluted money supply naturally depreciated to almost nothing, leading to the phrase, "not worth a Continental."
the people who held on to these metals intended to be patriotic Americans, concerned about America to be free of British control, lost everything. Whereas the Tories, who wanted nothing to do with this American government money, immediately got rid of it, were benefited. And Malachi Webster, the first American economist, and others who looked at this saw that this paper money, unbacked by gold, was extremely dangerous.
As early as the 16th century in Europe, goldsmiths stored gold coins for their customers for a fee and issued receipts for the gold to the depositor. Thus began the use of paper as money.
In other words, if you came in and deposited 10 ounces of gold for safekeeping, you got back receipts in the amount of 10 gold ounces. And those receipts entitled you to instantaneously redeem that gold.
These receipts soon became widely accepted as a means of exchange, since it was easier and safer to use the receipts for significant transactions. This was the origin of banknotes as money substitutes. These first bankers then took this process one step further.
In effect, if the goldsmith had 1,000 ounces of gold and 1,000 ounces of legitimate receipts being held by the depositor of that gold, he could increase his profits by merely printing up another 1,000 ounces worth of receipts and lending them out. In which case, he would effectively get 50% reserve banking, or fractional reserve banking. Only a fraction, 50% of the receipts were now backed by gold.
There was no longer a 1-to-1 ratio of paper to gold. Now there could be 3 or 4 pieces of paper in circulation for every unit of gold in the vault. These bankers were no longer simply storing or warehousing gold for a fee. They were artificially inflating the money supply and loaning out these phony receipts at interest. This system became known as fractional reserve banking and was later transported to the early American colonies. It formed the root of American commercial banking and ultimately the Federal Reserve System.
This is a fraudulent system. It's not allowed in any other business. If you had a grain warehouse that had loaned out the grain it was supposed to have in storage, that's considered criminal and that go to jail. But the banks are the one industry that's allowed to get away with this and to profit from it.
Alexander Hamilton became the first Treasury Secretary, and in 1791 set up the first Bank of the United States as America's central bank to expand the supply of paper money for the benefit of the government and the commercial banks.
Alexander Hamilton believed in a strong central government, and he saw a central bank as one of the means by which the government could be centralized and by which its power could be expressed.
Thomas Jefferson opposed this view. He saw a central bank as an undemocratic tool of the Northeastern banking establishment. It was dismantled after 20 years.
Jefferson was an opponent of a strong central government, and at all costs wanted to remove the central bank.
In 1816, the federal government made another attempt to set up an inflationary central bank. But this second Bank of the United States was denounced by President Andrew Jackson as a monster bank for benefiting a few at the expense of many.
They inflated the money supply, which brought about a boom initially, that is prosperity to the country, followed by a bust. When they stopped inflating the money supply, many businesses that had depended on the low interest rates that were introduced or induced by the initial inflation went out of business.
Jackson succeeded in abolishing the second central bank in 1836. But by then, speculators had set up hundreds of new private banks with little or no gold to back the notes they issued. The nation's monetary system became more stable when the United States introduced a gold standard in 1834. The dollar was worth approximately 1/20th of an ounce of gold.
The gold standard was understood by the founding fathers, by Andrew Jackson and others, as being money of the people. That is, it was a hard money, a money that could not be tampered with, that could not be inflated to permit government expenditures skyrocketing.
But by 1862, Abraham Lincoln needed to fund his invasion of the South. So once again, the government began to print up paper money.
Basically, the United States went off the gold standard in order to finance the Civil War. And you'll find in history that almost every large war, every major war, has involved a departure from the gold standard. Because the gold standard puts strict limits on government finance.
Lincoln's notes became known as greenbacks because they were printed in green ink rather than the usual black ink on the reverse side. These so-called fiat notes were deemed legal tender by the government, but they were not redeemable in gold.
Lincoln, at the time of war, issued a tremendous number of greenbacks. Gold was still circulating, and people were forced to accept these greenbacks as if they were part of gold.
The government's power to print unbacked paper notes would later become the pillar of the Federal Reserve System. After the Civil War, the nation's monetary system became sounder when the U.S. adopted a gold standard.
We were back on the gold standard. In 1879, we had probably the greatest period of growth and prosperity ever in the country's history.
For nearly 20 years, the total output of goods and services grew at an unprecedented rate of 4% per year.
The reason being that with a sound money, and without the ability to manipulate the interest rate, we have a lot of genuine saving and investment which then led to more capital goods and higher labor productivity in the United States.
In the midst of this prosperity, the big industrialists and financiers were plotting to expand their empires with the help of government. With the passage of the Interstate Commerce Act of 1887, the large railroads succeeded in blocking their smaller competitors through regulation.
The ICC was put in place in order to protect the railroad owners from competition. It was not the case that it was going to protect consumers or shippers. In fact, consumers were hurt because ultimately, with higher railroad rates, they were forced to pay higher prices for the goods and services that were shipped across the country.
By 1896, they were poised to do the same thing with the banks. Two camps emerged as leaders in this economic war. They were led by J.P. Morgan, the world's most powerful private banker, and John D. Rockefeller, the oil tycoon. Morgan and Rockefeller were great adversaries, but despite their business differences, they both favored a central bank. They wanted cheap credit and an inflated money supply to finance the expansion of their empires. Together, they led the campaign to sell the idea to the American public, which later led to the founding of the Federal Reserve.
If the American people got wind of the fact that this bank was not in their interest, in fact, they understood that it was in the interest of the financial elites who would use it to inflate the money supply and in doing so increase their own revenues, it would have been held to that. Legislation would never pass under those conditions. So it had to be sold to the American people as a way of making their currency more elastic.
The bank reform campaign received a boost in 1907, when there was a run on some of New York's biggest banks thanks to their fractional reserves. Panic spread among depositors who got wind of the bank's insolvency and tried to withdraw their money. The Knickerbocker Trust failed, and two other institutions went to the brink of bankruptcy despite a $35 million bailout from J.P. Morgan. Wall Street swiftly adopted the fear of bank failures to sell the idea of a central bank, or lender of last resort, to the American public.
So the Federal Reserve was to be the lender of last resort. In case any bank got in trouble, they wouldn't have to worry. They keep the cash from Washington, D.C.
The question is, however, whether it is really desirable to have such a thing as a lender of last resort. The correct position appears to me that every single bank should be responsible for its own debts and contractual obligations. And if banks, through imprudent policy, then go bankrupt, this should not be considered a bad thing, but in fact considered to be a magnificent thing, because bankruptcies, the danger of bankruptcies is precisely what makes banks adhere to sound policies.
Bank runs and failures continued at an alarming rate. In 1908, the National Monetary Commission, headed by John D. Rockefeller Jr.'s father-in-law, Senator Nelson Aldrich, was set up to push for a central bank. In November of 1910, under the guise of a duck hunting trip, 6 men took a secret train ride to an exclusive private club on Jekyll Island, Georgia, to write a central banking act. The classified gathering read like a who's who of American banking. There were 2 Rockefeller men, Aldrich and Frank Vanderlip of the National City Bank of New York, 2 Morgan men, Henry P. Davidson from Morgan Bank, and Charles D. Norton, president of Morgan's First National Bank of New York, Paul Warburg, a Kuhn Loebreaker, and Assistant Treasury Secretary A.P. Andrew, who was friendly to both camps. They spent a week at the luxurious club as Morgan's guests, crafting the proposals that would form the basis of the Federal Reserve System. It would be 3 years before their vision was realized. Just before Christmas 1913, the Federal Reserve Act was passed by Congress and signed by President Wilson. It established a Federal Reserve System to oversee monetary policy and regulate the commercial banks.
It's no coincidence that the Federal Reserve System was established by the Wilson administration. This was the height of the Progressive era, a time of tremendous government expansion and special interest deals in Washington.
There are 12 regional reserve banks concentrated in the East and the Midwest. The Board of Governors of the Federal Reserve controls and coordinates their activities. The board is made up of 7 members appointed by the President. Even though there were 12 regional banks, Wall Street soon ran the show. As president of the New York Fed, Morgan protege Benjamin Strong seized control of the board's open market committee operations. Strong would remain the dominant force at the Fed until his death in 1928. The Federal Open Market Committee, now based in Washington, directs the Fed's most important instrument of monetary policy, the purchase and sale of government securities on the open market. To increase the supply of money and credit, that is, to inflate, the Fed buys government securities from a few hand-picked firms with newly created money. To tighten money and credit, the Fed sells securities. In this, it can act on its own discretion.
Every government wants the ability to create new money. It's an alternative to raising taxes. Taxes, we said, when they're raised, tend to evoke a lot of resistance among the public. It's much less painless to increase the money supply. The effects, the negative effects, don't occur until 6 months, a year, 2 years later, at which time the increasing prices can be blamed on other factors, the weather, speculators, and so on.
Another device the Fed uses to control the amount of money in circulation is setting the discount rate. This is the interest rate charged to member banks when they borrow short-term from the so-called discount window. If the Fed lowers the discount rate for its loans, commercial banks will likely borrow more from the Fed. This increases the amount of funds banks have to lend. Bank credit thus becomes cheaper, as reflected in lower interest rates on bank loans and credit cards. The increase in funds available for banks to lend also increases the amount of money in the economy. The Fed can also manipulate the nation's money supply by raising or lowering the reserve requirement. Banks are required to set aside a percentage of their deposits as reserves to meet depositors' demands. When the Fed was established in 1913, it cut reserve requirements in half over the next 4 years, doubling the money supply by the end of World War I. But the Fed's real power lies in its monopoly to create money. Although the U.S. was still on the gold standard in 1913, it was quickly eroded as the Fed continued to expand the money supply. The first step was backing Federal Reserve notes by only 40% in gold, allowing the money supply to be increased 2.5 times. The inflationary effect of fractional reserve banking was also heightened by the central bank.
The commercial banks are permitted to create checkbook money on top of Federal Reserve notes. That is to say, the commercial banks are only obliged by law to hold reserves in the form of Federal Reserve notes of 10% to back all demand deposits that they have. 90% of their demand deposits are backed by nothing.
The Federal Reserve System adds another inflationary layer to an already unstable banking system. For example, if the central bank has $100 worth of gold reserves in its vaults and a 10% reserve requirement, it can print up $1,000 of new notes and deposits, which become the reserves of the commercial banks. The commercial banks take this $1,000, and if they're required to hold 10% again in reserve, they can multiply the $1,000 into $10,000 through fractional reserve loans. So an inverted pyramid is created with $100 worth of gold or real money at the bottom and $10,000 of inflated paper money at the top. As this $10,000 in new paper money circulates in the economy, it drives prices up. therefore reducing the buying power of ordinary citizens.
When they spend that money, people who get the new money first and are able to buy products with it benefit, and the people who get it at the end lose because when they go to spend it, prices have already gone up and so they're able to buy less. And so there's a transfer of wealth and of power from some segments of the economy to others because of the actions of the central bank. And basically those who benefit are the government itself, big banks, and government contractors, and anybody who's closely associated with the federal government.
By making enormous amounts of credit easily available, the Fed can also drive down interest rates, sending out the wrong signal to investors. It sets in motion an unsustainable investment boom that carries with it the seeds of its own destruction. It's this business cycle that is ultimately responsible for economic disasters such as the Great Depression. Soon after the Federal Reserve was established, the U.S. entered World War I. Once again, the government temporarily abandoned the gold standard to print more money to finance the war effort. The U.S. government borrowed heavily, and the national debt ballooned from $1 billion to $27 billion. A sharp spike of inflation followed. This set off a cycle of rapid expansion and contraction in the economy. To dampen the overheated economy, the Fed halted its inflation, causing interest rates to nearly double over the next 18 months. By 1921, the market began to recover. New technology helped to increase productivity. Markets developed for new cars and appliances. The 1920s were a period of extraordinary growth. But behind the scenes, much of this growth was distorted by a Fed-generated inflationary credit expansion.
This was the roaring 20s. This was a period of increasing affluence. That hid the inflation from American economists.
The Fed-generated bubble burst in the Wall Street crash of October 1929. Speculators who had borrowed money to buy shares when bank credit was readily available saw the stock market lose 1/3 of its value. Bank loans totaling $7 billion were outstanding. As the speculators defaulted on their loans, bank failures spiraled and the Great Depression set in.
Depositors lost their bank accounts, both for savings deposits and checking deposits. They saw them disappear into thin air.
In 1932, Franklin D. Roosevelt was elected president and quickly implemented a New Deal policy of spending us to prosperity. Even though we needed lower taxes and lower spending, his administration would seek unprecedented amounts of money to finance its big government programs. In his inaugural speech on March 4, 1933, Roosevelt vowed to put an end to poverty and the unemployment lines and get people back to work. It didn't work. The Depression got worse, thanks to increased central planning. FDR only succeeded in making the monetary system even less sound. Just after taking office, the president declared a 4-day nationwide bank holiday, absolving the bankrupt fractional reserve banks of any need to repay their depositors. But before the banks reopened, the Roosevelt administration had to come up with a scheme that would lead people to believe that new deposits would be safe. It created the Federal Deposit Insurance Corporation to lull the public into a sense of security. In reality, the Federal Deposit Insurance Corporation holds just half of 1% of all the deposits it insures. But what people are counting on is that the Fed, as the lender of last resort, would step in and print whatever money would be necessary to prevent a massive bank run. By the mid-1930s, control of the Fed by the New York bankers was drawing to a close. The Morgan era ended when President Roosevelt, who was no friend of the Morgans, appointed Mariner Eccles as its governor. Eccles, a Republican from Utah, moved the activities of the Open Market Committee to Washington. President Roosevelt was on hand for the dedication of a new $3.5 million building to house the Fed.
I dedicate this building today to progress toward the ideal of an America in which every worker will be able to provide his family at all times with an ever-rising standard of American comfort.
1933 also marked the beginning of the end for the gold standard. There was no end to Roosevelt's appetite for spending on such New Deal programs as the gigantic $13 billion Tennessee Valley Authority, which flooded vast areas of productive farmland to provide government-subsidized electricity. The Works Progress Administration, which spent $11 billion on make-work jobs and pork barrel public works. But the U.S. currency was tied to gold, which limited the amount of money the Fed could print to pay for these costly projects. So the government scrapped the gold standard for American citizens in 1933, and then Roosevelt confiscated the people's gold. As in World War I, the warring parties in the Second World War abandoned the gold standard to finance the war with central bank-generated inflation. After the war, there was an attempt to use the prestige of the gold standard to establish a global inflationary system. The world's financial leaders met at Bretton Woods in New Hampshire under the direction of the famous economist John Maynard Keynes. Their idea was to set up a new international monetary system that would have both gold and inflation.
Under this system, the U.S. dollar would be redeemable in gold, but only for foreign official institutions, central banks, and foreign governments, at the rate of $35 per ounce. All other currencies would have fixed exchange rates with the U.S. dollar, and they would be redeemable in U.S. dollars.
The New York Times editorialist Henry Hazlitt was one of the first to realize that this semi-gold standard would not succeed.
Even from the very beginning, it was doomed to failure, and this very outstanding journalist at that time, Henry Hazlitt, predicted it wouldn't work, because he says the temptation will always be that the government will print more money because they will accept these dollars and they won't demand the gold and won't hold the government in check. And he was absolutely right.
During the 1960s, the U.S. government was trying to meet the cost of massive social welfare programs at home and the Vietnam War abroad. By printing more money, President Lyndon Johnson believed the U.S. government could accomplish its goals without raising taxes, which may have caused a taxpayer revolt. In other words, it could have both guns and butter.
We will make sure that every dollar is spent with a thrift and with common sense, which recognizes how hard the taxpayer worked in order to earn it.
But the more money the U.S. printed, the more it eroded the value of the dollar. Nervous foreigners began redeeming their dollars in gold, as they were entitled to do under the Bretton Woods Agreement. After paying out billions in gold, the U.S. was left with $36 billion worth of outstanding debt to foreign creditors and gold reserves worth just $18 billion. Rather than stop the inflation, in 1971, President Richard Nixon refused to redeem any more dollars.
I directed Secretary Conley to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
It was the death knell for the Bretton Woods semi-gold standard, and a triumph for the Federal Reserve. The dollar would no longer have even the illusion of a fixed value against other currencies. It would float against them, causing even more dislocation in foreign trade and massive uncertainties for businessmen. Worse, the final check on dollar creation disappeared, creating endless possibilities for inflation. It's running at more than 300% since 1971, thanks to the Fed's power to create money out of thin air and to insure deposits. No U.S. federal budget has been balanced since it abandoned the gold standard.
I don't think that that's something that enhances the efficiency of our economy. I believe that the best money is a market-determined money. It's such as the gold, such as we had under the gold standard. In order to get back to market-determined money, the Fed has to be abolished.
There is not now, nor has there ever been, any direct control over the Fed by the President or Congress. The meetings of the Federal Reserve Board are held in secret, and nobody knows exactly what goes on. If you watch the business report every night, commentators are constantly speculating about what the Fed might do.
All eyes were on Washington today as the Federal Reserve met to decide the future direction of interest rates.
Most economists expect the Fed to leave monetary policy unchanged.
It has spawned a whole industry of Fed watchers who try to second guess the Fed.
The Federal Reserve has been surrounded by secrecy ever since planning its installation and its operations to the present day. And the reason is because they can't tell the truth. If they told the truth, there'd be a revolution. There'd be a bunch of Americans get ready to toss them out of the building.
A recent attempt to open the Fed to public scrutiny came in 1993. The head of the House Banking Committee, Representative Henry Gonzalez of Texas, called for an independent audit of the Fed's operations. He wanted the proceedings of the Open Market Committee videotaped, with detailed minutes released within a week instead of vague summaries issued several weeks later. Gonzalez also proposed that the president choose the 12 heads of the Fed's regional banks instead of powerful bankers. Predictably, Fed Chairman Alan Greenspan resisted the changes. What was surprising was President Bill Clinton's position. He declared the reforms would, quote, run the risk of undermining market confidence in the Fed. After the Mexican government inflated and devalued the peso in 1995, the Mexican economy went into a tailspin. Alan Greenspan lobbied Congress and the Clinton administration for a $52 billion bailout. As it turned out, the Fed's member banks held as much as $26 billion in Mexican debt. With no choice in the matter, American taxpayers and savers paid the bill.
The congressmen themselves, from my experience there, they're pretty naive and they don't understand that the few that have to, like the chairman of the banking committee, is aware of this and goes along with it, and they continue to perpetuate this myth that the Federal Reserve brings about stability and they do good things for economic growth, even though they're the culprits. They're the ones who caused all the problems. They're the ones who caused the recession, the unemployment, and the downsizing of big business and all of the ill effects that we have to witness. But their PR job is excellent because they've convinced most congressmen that they are very necessary to maintain stability and economic growth and all these wonderful things that they claim credit for.
It is clear that the United States cannot rely on Alan Greenspan or any other Fed chairman to fight the chronic inflation that has wrecked our savings, distorted our economy, redistributed income and wealth, and brought us devastating booms and busts. Despite the established view, Greenspan, the Fed, and big commercial bankers are not the inflation fighters they pretend to be. The Fed and its allied banks are not part of the solution to inflation in the business cycle. They are the problem itself. To limit chronic inflation and boom-bust business cycles, the currency must be backed 100% by gold. That would remove the Fed's ability to print money, which amounts to no more than legalized counterfeiting. Instead, there would be a monetary system where gold serves to anchor the dollar, rather than the fiat reserves created by the Fed.
If we were to establish a real gold standard, the average American family would benefit tremendously. First of all, there'd be more jobs, better jobs, more secure jobs, more business opportunities, more business cycle, more recessions and depressions. People's savings would be secure. You wouldn't have to worry if you put away money for your old age, that its value would be stolen by the central bank and by the central government, as they are today.
Under a 100% gold standard, there would be no place for fractional reserve banking. For checking accounts and other demand deposits, the banks would keep reserves on hand to meet depositors' claims. Banks would receive a fee from their customers for keeping their gold. In loan banking, investors would hand over their money for a fixed period of time to earn interest. Once the gold standard is in place, individual bank depositors would always have access to their money, and investors would be kept informed of their balance sheet. And at a national level, a tight rein would be kept on government spending.
You have relatively price stability. You have a stable purchasing power for the money. You eliminate the business cycle. You have reasonable interest rates rather than gyrating interest rates, and you get rid of the political manipulation of interest rates and political manipulation of the money supply. And this then preserves wealth, builds wealth, and allows for economic growth.
It's as simple as this. Sound money means economic prosperity and limited government. Unsound money means inflation, recessions and depressions, and big government. What sort of system do we want for our families? Don't we want prosperity and security that we can hand on to future generations? Transition to a gold standard will not be easy, but as Murray Rothbard put it, the alternative is much worse. Since 1980, the Fed has enjoyed the absolute power to do literally anything it wants. To buy not only U.S. government securities, but any asset whatever. To buy as many assets and to inflate credit as much as it pleases. There are no restraints on the Federal Reserve. The Fed is master of all it controls. For more information on the Federal Reserve, write the Ludwig von Mises Institute, Auburn, Alabama, 36849-5301, or call area code 334-844-2500. Also available from the Mises Institute is The Case Against the Fed, an insightful...
All right, so sorry to have to do that to all of you. I really do apologize. That was rough. But yeah, it just kind of gives good background to what we're going to be talking about today. We're going to be talking a lot about the Fed, kind of what they do, how they regulate everything, and that just kind of gave just a little bit of background into all of that. So
now y'all don't be so, Anita, I know you love that video. It was wonderful 1980s, everybody, wasn't it?
Yeah.
So ecstatic, right? So much fun and everything that goes into it.
First film.
Let's see here. Miss Sheldon's not here tonight. Well, no, there she is. Miss Sheldon, I know you had tons of fun watching that video. She ain't even.
Zoned out.
Sheldon, you going to sleep over there, girl?
You know what? I have a reason to be zoned out. I have been vomiting my brains up since 12:50 in the morning. So.
Oh my gosh, girl!
At least you're here, I guess.
Yeah.
Oh my gosh. Well, you get feeling better. If you need something, you call me. I know Gio.
Thank you.
Ecstatic. Gio's he was enjoying that video. I know for a fact.
Happy to be here.
All right, but go ahead. Keep on going.
Alrighty, sounds good. So yeah, tonight we'll be talking about the money and the monetary system throughout the United States. It should be a pretty interesting chapter. We're going to get into a lot of discussion and hopefully get y'all out of here in the next hour. So the first slide, what is money? Hit me with your definition, Wyatt. I mean, what is money to you?
What is money? It's like the value of trade. I don't know, like I just see this the trading network.
Trading network, okay. So it's kind of somewhat into what they were talking about, bartering and that kind of thing. Got you. Gonna give me your definition. What's money to you?
The currency which people use to put value onto something.
Value. Lots of talk of value. Yeah. So pretty much, yeah, exactly. Money is basically whatever you consider. It can be anything that you consider something of value. So would, how much value does this water bottle have to you? Wyatt? Not a whole lot. Yeah. Well, that's the thing. It differs for me because I see it. That's my water bottle. I use it every day. I love it. Keeps my water cold. I sip out of it constantly. So I find a lot of value in that. And so that's a big thing is we find value in different objects very differently comparatively. Could you, for instance, McKenna, could you say that you want to trade me your iPad, and for doing that, I will mow your lawn for the next year? Is that something that, hypothetically, that could be done?
Yeah.
Because you consider your iPad valuable. I also consider your iPad valuable. Well, you consider your lawn being mowed. You like a nice fresh cut lawn, yeah?
Yeah.
Yeah, why not? And I consider my time valuable. So we're switching two things that we both see in value. We're switching against each other. We're both happy in the end. Plus, plus. Like a certificate, a CD, we'll say. Do y'all know what a CD is from a bank?
I know what a compact disc is.
Compact disc. That is also a CD. But Miss Vita, what is a CD?
It's like a savings account that kind of gains interest for the money that you put in there. So I guess the bank kind of uses your money in their interest, so they give you interest.
Yes. So if you go put $5 million into the bank and they give you a $5 million piece of paper, or a piece of paper that says you have a CD and that certificate of deposit is worth $5 million, does that have as much value to you as this piece of paper?
Technically no, but according to them, yes.
Yeah, according to them, yes. So it's depending on what is on the paper, what it stipulates, what it represents is what gives it value. So kind of getting back to the point, money doesn't have to be necessarily cash. It doesn't have to be that green stuff right there. Money can be whatever, something that you consider and hold value in. Moving over to the supply and costs of money, I'm going to relay it kind of towards our class more and talk about in real estate. This new administration, they've kind of been talking about relieving student loans, and along with that, they've also talked about relieving mortgages. And I mean, if you wipe out billions of dollars in mortgages that the American people have right now, it's going to have some impact on the American economy. Now, I mean, kind of what impact would you say that it has on the American economy? Why? If they were just to wipe everybody's mortgage debt, what would kind of be the chain effect? What would happen?
Well, wouldn't it eventually be negative? I just see like negative wipe out it, like because that all has to be paid, right?
Yeah.
So if we all get wiped out.
They just wipe it out. The money's gone. It just disappeared.
Where's
the
debt's
money?
gone.
The debt's gone, but where'd the money go?
That's.
Well, yeah, no,
It just disappeared.
Yeah, that's what I mean. I think it'd be kind of bad,
Yeah, I think it'd go bad, wouldn't it?
Probably cause a crash.
Yeah, it causes a crash because I mean, really, there's two ways that once debts are forgiven like that. I mean, the money's going to have to be paid back, or the bank could just go bankrupt, which a bank going bankrupt is never what you want to hear. I mean, if banks start going out of business, that's bad news for everyone. So who they're going to turn to is the federal government and get bailouts from the federal government. So when the federal government gives them the $10 billion or whatever it takes to bail them out, where is that $10 billion that the government has? Where's that coming from?
They're printing it, right?
Yeah, most of it, a lot of it's printed. A lot of it is printed, but a lot of it also comes from our taxes. So yeah, they'll just raise taxes. So in essence, you're not going to be your mortgage isn't going to be completely wiped. They're going to spike up taxes and you're going to pay it through taxes, which kind of messes with everybody else because if the people who have mortgages and have paid them off and now have all the equity built up in their house and they own it completely,
they have to.
Well, it just kind of screws all the work that they put into building that equity and owning the home itself. So if people default, the banks are either gonna have to go to the government or go bankrupt. So technically, there is no such thing as free money. Like these stimulus, these trillions of dollars that we've printed out in the last year. McKenna, where do you think that the trillions of dollars that we've printed out, where does that come from?
our own pockets eventually.
Well, yeah, I mean, that's right, exactly. We're buying, or China technically is buying our debts right now, buying up a bunch of our debt, and we're going into debt to China, and we're just printing money backed off of that. And I mean, who pays? I mean, is anybody going to start paying their stimulus money back to the government so we can pay China? I mean, I didn't send my $1,200 check right back to the government. That's for sure.
I don't think you could if you wanted to.
No, I mean, no, I think there's a lot of.
Well, the government has to collect money through taxes, I believe.
Yeah, I mean,
Or
it's.
trading.
Yeah, it'll all be done through taxes at the end of the day. That's just how it is. Free money is not a real thing. Anytime you walk by a store and you see a buy one get one free, there's no such thing as free. If you would have gone to the store 2 days earlier and bought 2 of them, it might have been just a couple more dollars, more expensive than if you go get the BOGO. But relatively, you're not going to be saving and getting an actual free product of whatever they're offering. I know Justin said, talked about one time when he was working in retail, that shirts were going for $12.50 a pop. And then it came one weekend and they wanted to run a BOGO offer. So they, buy one shirt for $24.99, get one free. Well, he realized I mean, this is BS. I mean, nothing, they're not getting it for free. They're paying the exact same amount. But they're just, see a big sign with free on it, and that's going to attract a lot of people. Kind of talking about stimulus and stimulating the economy and kind of where we're at right now. When buying a house or buying a car, we'll kind of take a car because a car is an easier example to talk about. When you buy a car, who benefits from you buying a car? Is it just the dealership that you buy it from? No, it's not only the dealership and the salesperson that sells you the car, it's also the maintenance people in that dealership. Your money goes to pay those people. Your money goes to pay the manufacturer. If you buy it off of a new car lot, it's going to go to pay the manufacturer. It's going to go to pay, I mean, all sorts of people. It can be divvied up down the line to hundreds of people that, your $30,000 purchase of a car is what it's going to do to the economy. So now the Federal Reserve, and this is what, obviously what it talked about in the video quite a bit. Franklin Roosevelt is the one who kind of put this into action and created the building. This is the actual Federal Reserve right here in Washington, D.C. Just a great looking building, honestly. It looks architecturally sound. A lot of pillars, not as pretty as it used to be back in the day. I wish we'd go back to the old, European type of architecture, but I don't know. This is the more modern era and what we go with today. But the Fed is the monetary manager of the nation's economy. They kind of run things. They run interest rates. I mean, they are the economic managers of our country. And it's made of the central bank, which is this one right here, and the 12 district banks. Just a side question, does anybody know where the nearest federal district bank is to us all across the country?
I thought it was like your region of Dallas.
Yeah. Our district federal bank is in Dallas. It is located in Dallas, which is pretty cool. Yeah, I've never driven by it. I don't know what it looks like, but I assume it's pretty cool. So it's made up of all of the 12 district banks, and then all nationally chartered commercial banks. So banks such as J.P. Morgan Chase, Wells Fargo, those types of entities, they are required to join the Fed and report to the Fed since they are nationally chartered. And in their chartering, their fees are pretty high to get in, as you could assume. Banks, I mean, all they do is deal with money, so their fees are pretty high. And they have, as it was talking about in the video, is they have reserves that they have to keep within the Fed. And it's typically if a bank has reserves, if they have a total deposits of $127 million or more, they're required to keep 10% of that reserved at the Fed for next day operations, emergencies, those types of situations. But as of March 26th of 2020 last year, as a result of COVID, those requirements and reserves were dropped down to zero. So now federal banks, nationally chartered banks, and state chartered banks are all, none of them have to keep, none of them are required to keep reserves with the Fed, which allows them obviously to loan out more money, which is what they want to do. And kind of going back on their reserve requirements, basically what it is if y'all all worked for me, and after a week of work, I paid y'all $2,000 because that was y'all's pay for the week. And then I was like, well, y'all's pay is $2,000, but I'm gonna keep 500 of it just for when I think y'all need it. I mean, how would y'all feel about that? Yeah, you'd be pretty ticked. Kind of like, what's going on? Yeah, and that's kind of how all the nationally chartered, the national banks and the state banks feel who have joined the Fed. Banking is a business. When you get down to the nuts and bolts of it, banking is a business. And what are the goals of the business to you? Yep, money. It's all about making money. So back in the day, I kind of thought, oh, well, banks are really there to hold our money. If we need it, we can go pull it out. If we need more money, we can go take out a loan. I always thought they were kind of there for our utility and our use. But that's really not true at all. They are solely to make money. That's their number one goal. And I mean, they'll pretty much do whatever they can to make as much money as they can. And let's have somebody on the line. Gio, what is the primary source of a bank's income? What do you think it is?
I would say interest.
Interest payments? Yeah. So.
Yeah, like interest payments collected through the people.
Exactly.
Borrowing money.
So yeah, with a bank being a business, they do hold a lot of deposits for their customers and all of their needs. They handle a lot of customer transactions, but their main source of revenue is loans. So giving out loans, and then like Gio said, the interest that they make off those loans is where they pull the majority of their profits. So we'll actually go to this next slide. It kind of talks about it a little bit. Just a couple things. We'll get back into the loans and talk about that with these open market operations. But the Federal Reserve, like I said, it regulates the reserves required by the banks. It's continually bouncing up and down. As I said, in March 26th of last year, they completely wiped away all the reserve requirements. So now banks are required to have zero in their reserves. They can have a balance of zero, so they're loaning out as much money as they possibly can, trying to make the most, which results in more profit for them. So they're happy with it, and the Fed is okay with it because they're trying to pump more money into the economy and stimulate it and get us rejuvenated. They also determine the discount rates and the discount points that are required by loans. These are there are more percentages of what clients can use to their benefit in loans in regards to their payments and stuff. They're able to mess around with those discount rates and points to try to get a more economically viable payment plan. And then the balance of the economy through open market operations. So this was talked about quite a bit in the video. The Fed buying and selling Treasury notes of its member banks to balance the interest rates. So when the bank wants to raise interest rates because there's too much money flowing in the economy, well, with too much money flowing around in the economy, interest rates will tend to rise because, as I said before, with the banks are trying to make as much money as possible. So they'll continually and gradually raise those interest rates to try to increase their profits. So when the Fed buys these Treasury notes from its member banks, it adds credit to the bank, and, technically giving the bank money, so it's able to delve out more money in loans to make more profit itself, which lowers the rates. Once they start giving away too much, they start want to keep making more profits, make higher profits. Then the Fed will sell these Treasury notes to the banks, taking reserves out and taking their liquidity away, which raises the interest rates back up. And then supervising the Truth in Lending Act. The Fed goes in hand, basically oversees everything that happens through TILA, and in that form that we saw yesterday, they basically just require and regulate all of the notifications and disclosures that are required to give, that banks are required to give people who are lending throughout their institutions. So they oversee all that and make sure that all banks are within those guidelines. So a little more about the old TILA here. Kind of what is covered by TILA, and you will be asked on the real estate exam what is covered by TILA. It's very, very frequently asked. TILA covers all real estate loans. So if you're buying or selling property of any sort, or if you're buying property, of any sort, you will get a Truth in Lending Act notification and certificate letting you know, as we said, or as I showed you yesterday, the amount that's being financed, the interest rate percentage, the interest amount that you will be paying, and the total amount combined. That is required at all times if you're buying real estate. Personal loans, any personal loans that you take out, those are also required to come with a Truth in Lending Act. And then consumer loans, and this is kind of where they'll try to get you on the test, is they'll talk of consumer loans of $50,000 or less. They like to put or more, but you need to know that it's the consumer loans of $50,000 or less. That was kind of one thing that Justin notified me and warned me about before taking my test. And luckily it was one of the things I wrote down in the class, and they actually did end up asking me about it. So when I saw that question, I was like, oh, bang, there we go. I know that's automatic. So you do want to know that it's consumer loans of $50,000 or less. And Regulation Z, these are kind of Regulation Z is the main regulation that is required by the Truth in Lending Act. The Truth in Lending Act is obviously just a piece of legislation that was passed. Regulation Z is like the actual specifics of what is happening in the Truth in Lending Act. And it goes over the required disclosures that are supposed to be given to clients. It also goes over the annual percentage rate, which is required by all banks. Obviously, like we saw in the TILA form yesterday, percentage rates are required, and you will need to know that. And it's something that you will want to know going into when you're financing a loan, whether it be for a house or a car or anything. You're going to want to know that percentage rate and what that means and how it affects your loan. Advertising here. Now, in regards to advertising, banks used to, we'll kind of put it in these terms. So Black Friday. Does anybody remember their first Black Friday shopping experience and kind of how crazy it was?
First, probably not.
No?
But definitely remember some fun ones.
Some wild experiences?
Wild, yeah.
And what were you going to buy when you saw the crazy things that you saw?
Literally nothing.
Nothing. You're just going to look. Typical Black Friday.
Yeah.
Respect. Okay.
Yeah.
Understandable.
Went to find the deals. That's all I was doing.
Okay. Well, I understand. I'm a deal searcher too. But so in talking about Black Friday, I am going somewhere with this. JCPenney back in the day advertised a ring that they had, a new rings that they were going to put on sale, and this ring was $12.99. Well, they started advertising for Black Friday, and they advertised this ring that was originally $12.99 for $5.99, and that it was only offered on Black Friday. So, I mean, as you can expect, getting $700 off a diamond ring is, a pretty good deal. And so there were a lot of people who really wanted to cash in on this deal. Well, do you know how many rings would you have expected like JCPenney to have on stock?
If it is an ring like that, you're selling it for that cheap, they should have a lot on stock.
Yeah.
Probably didn't.
Yeah, no. So that was a big thing.
Did it have diamonds on it?
It had diamonds. Yeah, it was a real ring.
I would say 50.
Yeah. You'd think they need 50. I mean, it's probable that 50 people would come in and try to buy this ring. Well, what they did is they just sent one ring to every location.
Oh.
And so in doing that, I mean, once the doors on Black Friday opened, I mean, everybody was flooding to JCPenney trying to get this $1,300 ring for $5.99. And obviously the first person there was very lucky and got to cash out on that ring. But the second person who asked, when you came up and you asked, yeah, I want that, I want one of those rings as well, the $5.99 deal. And they're like, oh, I'm sorry, we just ran out. I mean, how would you react to that? Yeah, you'd be like, well, what the heck? I'm the second person here. How do you only have one ring?
Yeah, you probably think you do.
Yeah. So, and that's just kind of banks were doing the same thing back in the day. They were advertising, zero cash down, no payments for 90 days, nothing out of pocket, and you can buy a new house. Well, that's not really true. When it comes to closing on a house, there's closing costs for sellers and buyers. If you're the buyer, you're gonna want to pay for a survey. You're gonna want to get a new survey. You're gonna want to make sure that property is appraised. You're gonna have to pay for an appraisal. There are costs that come with purchasing a house, and so the same that happened with JCPenney. They got into a bunch of lawsuits, a ton of lawsuits. Their customers were very, very upset with them, and the same as with the banks. There were a lot of people who went into the bank thinking, oh, well, I don't have any money right now, but most likely will in 90 days. I don't have to do anything. They get into a big home loan, and next thing you know, they're SOL, and the bank has to foreclose on their house, take a lot of their assets because of some false advertising. And so that's where Regulation Z, covered by TILA, it doesn't allow that to be done by banks anymore. Banks have to be 100% truthful and upfront with everything they propose now. So they're not catching clients in sticky situations and putting them in harm's way economically. And then in regards to the right of rescission, it regulates the right of rescission, and that is in terms of refinancing a loan. So say Vita has her home loan, and she wants to get it refinanced, get a better interest rate. So she goes into her bank, and Wyatt tells her, yeah, you know what, you've been paying 5%, and I agree that's a little high for right now. So I'll tell you what, we can move it down to 3%. Well, Vita is super excited about that. Having to pay 5% interest down to 3% interest doesn't sound like a lot, but as we discussed yesterday, over the life of the loan, that's going to be a crap ton of money. So she's super excited about that. Well, she sees on TV that night that Stefan, the Bank of Stefan over here, is refinancing a bunch of loans, and he can get you for as low as 1.9% right now.
That's how it's real quick.
Exactly. Well, Vita's upset right now. She's like, well, dang, I did get a reduction, so I'm happy about that. But I mean, 3% to 1.9%, that sounds fantastic as well. Like, I'd really like to get down to that 1.9%. And Regulation Z, really what it does is it gives residents who are refinancing their homes a 3-day period to back out of that refinancing option. So if they are able to find a better deal, they're able to back out and go sign with that better deal instead of being stuck on that. Because say if you were to sign on the loan for a new house right now, you're completely stuck in that. You're completely stuck in that loan. There is no backing out of a home loan for a purchase of a house. But refinancing, you got that 3-day period where you can back out and go cash in on a better offer. And obviously, I recommend you do that because who wants to pay more money for what they got?
Yeah, there's closing costs when you refinance too.
Exactly. Yeah. And that's kind of going back to that last slide when there, a few slides back talking about free money. There's nothing in this world that is free. And it's all wrapped up in something else. It always has been and always will be. Talk about maybe a slide that stock switch. I'm talking about the United States Treasury. Now these are the people that print all the money. These are the money printers. The Fed is basically the bank. So they kind of go hand in hand with one another. This is the nation's fiscal manager. It houses the Office of Comptroller of Currency and the Bureau of Engraving and Printing. And they deal a lot with Treasury bills, notes, and bonds. So in talking about the Treasury and finding out when I was younger, kind of what the Treasury did, and it was just my youth and lack of knowledge, but I always wondered, if so many people in this country need money, why don't we just print a bunch of money and if you can give everybody, print a bunch of money and give everyone $10,000, shoot, why are we doing that? That seems like the most simple solution ever. But again, like they were saying in the video, once you print a bunch of money, what happens to the value of that money? Yeah, it goes down, it deflates because there's nothing backing it. There is no work, no value.
I remember I told you that in the last 10 months, they printed 30% of all the money.
Yeah.
It's nuts.
So after watching that video and knowing that statistic, it's a little scary thinking about where we're headed right now economically.
Unfortunately.
But
For 4 years.
yeah, I think it's gonna be a lot longer than 4 years. We're gonna be in this for a while.
It's for the long haul.
Huh?
I said we're in this for the long haul.
Yeah, something's coming. But and another thing in regards to talking about value, because that's really the main topic of this chapter right here is value. Like Wyatt said earlier, right now this water bottle has basically no value to him. Has a lot of value to me because it's mine and I spent my money on it, and so I do put value on it. But say this water bottle had the last little bit of fresh water in the world. How does its value change then? Would you want this now?
Yeah.
How much would you pay for it?
All of it. Yeah, it's all whatever I can get.
Whatever. Yeah, whatever you can get. So that's kind of talking about the backing and the kind of the value that's put into our dollar. It's kind of the same as this water bottle, saying that it's the last little bit of water. Is it technically? No. It's not the last little bit of water on there, thank God, or else we'd all die. But the value that our money has right now is it is technically fiat currency. It is not backed by anything. There is no meaning to it. There's no value. But if I were to pull a $20 bill out of my pocket right now and toss it on the ground and say, who wants it? y'all might not fight like dogs, but somebody would definitely come up here and get it, you know? Okay, well, there you go. Y'all better watch out for Vita. She's coming from the back.
I got kids to feed.
I got kids to be, I got diapers.
You know, so, yeah, that's just kind of in regards to that. Talking more about value. Then the FDIC, who all has heard about the FDIC? Have you seen their notices on banks? You know, when you go to a bank teller desk, you see FDIC on the counter. Have you ever seen that or no? No? Wow. When was the last time you were in a bank?
I mean, a couple months
Great
ago,
question.
but yeah,
Wow.
I don't think I can pay attention to the surroundings. I'm there for business.
I got you. Okay, no worries. I understand that. Well, banks, kind of like we were talking about, Travis was talking about last week, how we have to show a consumer protection notice in our office, and we have to show the IABS, the information about brokerage services, that gives all the information about the brokerage. Banks have to post these FDIC notices, and they are all the what that is, and I know you can read, is the Federal Deposit Insurance Corporation. So what that does is it insures deposits at banks and thrifts up to $250,000 per account. So say you have $1 million, would you want to go put all that $1 million into one bank account?
Nope.
No? And why is that?
Because it insure the whole million.
Yes. So another question, would you want to put it into 250,000? You obviously want to break it into $250,000 separate accounts, or even less if you wanted to accrue that interest and have that interest insured as well. But you'd want to put that into different accounts. Would you want to put those accounts all within the same bank?
Probably not.
No, why is that?
I just would have it at different banks. I don't know why, but I just would.
Yeah, well, I mean, what if that bank goes under one day?
Yep.
And
Yeah.
without notice, you know, they're out, you know, you're out of luck.
Yep.
And, you know, going through their liquidity, trying to get everything out, the FDIC is going to pay you that first $250,000, and then they're going to hold off and make sure to get everybody else before they get you that second round of $250,000, and the third round, and the fourth round. You know, so I mean, if any of y'all, I'm sure somebody someday will be a millionaire. If you take anything from this class, don't keep all $1 million in one bank account. Don't keep it within the same
Where's
bank.
Jeff Bezos putting all his money?
Stocks and bonds.
Stock and bonds?
Yeah. I mean, all
Or he just holds it under his mattress? All like 20 trillion?
All in
Yeah.
his wallet.
the majority of his net worth is made
All
up
of
in.
it.
is-
It's in his back pocket.
That would be pretty well, but the majority of his net worth is based out of the equity that he has in the Amazon company. So it's not really liquid cash. That he doesn't have, 128 billion or whatever he's worth in just cash, sitting in a vault in his house. But he's got it in.
something.
He's
Oh, yeah.
invested in a lot of stuff.
Yeah, I don't even think he's invested in a lot of stuff. His team of investors that he employs.
He doesn't even
invested in.
need to.
No.
He's got the money.
Yeah. Yeah.
Have
he
other
just-
people figure it
He
out.
just sits back and rates some money.
Yep.
Exactly.
His wife, she's making a
She been
Oh.
making half much
His
just for
wife-
walking away.
Yeah.
That's great.
She just
she's-
walked away.
She'll probably get killed off in a few months. Hey, walking away with that much money, someone watch her for a while.
Yeah, I heard, and I don't know if y'all saw, but Bill and Melinda Gates yesterday,
Yes.
they actually separated,
Yeah.
which is
It's
crazy.
sketchy.
They haven't
Yeah.
been together a long time. So
Son, they-
27 years. Gone out the window all of a sudden. Yeah, you gotta watch her. Gotta watch her.
How do you know the exact?
I just saw something before coming into the class.
Oh,
Like
okay.
it says 27
This guy
years.
knows the actual year.
You're gonna say
I
something?
think it was him. I think he did something.
Really?
He seems very sketchy.
He is definitely a different dude, and yeah, don't get me started on Bill
I'm
Gates.
telling
I'm not a big
you.
fan of Bill Gates, but I mean, he has done some good for everything, but.
So isn't he trying to create a layer to reflect the sun from
With
penetrating
gold?
the earth? Yes.
Mhm.
Wait, what?
He's trying to stop like the or whatever the thing that stops the UV rays from the sun. It's
Yeah.
like breaking or whatever, he's trying to make a gold reflected like shield, basically like that we'd see it, so we'd be in a gold bubble to reflect the sun.
Why?
So the rays don't get down to us and like damage us, make it worse, like the ozone layer or something like that.
That sounds like Elon Musk territory.
Yeah, well then it's like a gold reflected bubble where
It's kind of like what a
But then we
volcanic
wouldn't have
eruption would do to us with the ash cloud, but he's trying to make it out of some other stuff. So he's trying to pull down the earth. I mean, what kind of repercussions is that going to have when it comes down to like farming and to the animals and
and our health, because we need the sun for just like.
I don't think he's trying to block it out completely. He's just trying to the damaging part of it. He's trying to like slow it down. That's all. But still,
it's like still.
He's trying to play God, is what he's trying to do.
exactly what
all of them are.
Yeah.
I mean, he's got.
They're talking about moving people to Mars and stuff like. They're trying to like really like cause out. Like what?
Yeah.
We're here to die. Why are we trying to? Why are we ain't trying to move?
Yeah, they're not trying to allow him. They're just like coming into all kinds of issues trying to do it. So he's trying to do it through private investors and
Really?
yeah, he's trying to get around it.
Well, I saw about a month ago, kind of off topic, but he just became, it was a month or two ago, he became the largest private landowner or privatized farm landowner in the United States.
Oh, that's not good.
So he owns the majority of the farmland here in the United States.
In the United States, I mean, that's not including what he's doing in Africa.
No, yeah, they're all over the world with these hundreds of billions of dollars. Yeah, you can.
And the less restrictions you have in other places is what's crazy.
Yeah.
It's like, what are you doing there?
Get
away.
I don't want to know what you're doing here.
We have no idea. It's that is a scary situation. Bill Gates.
All of them, bro. Facebook or the internet, and he was like weird. Watching any of his videos, I can't remember his name. Zuckerberg or something? No, it's not Zuckerberg.
Yeah,
Maybe, I don't know.
Mark.
Some dude, real pale face, but
The one with the beard?
I don't know. If he's
No, no,
he's
that's-
the youngest of them.
that's
That's how I
the-
just remember him.
I don't know.
I don't know. I've seen him before. He's creepy.
Well, the fact that they're selling everybody's rights to anybody that's willing to pay for it, like they're selling your privacy.
Yeah.
And then how is it so coincidental that you speak on something and somehow your phone manages to hear that and start showing you ads on what you just said?
Oh yeah, no, it's.
I hope I get conspiracy things popping up now after this talk.
Oh, you
Yeah,
will.
it's class.
You will.
Conspiracy theories.
Bill Gates. Yeah, yeah. We ran off from the FDIC to Bill Gates and.
Yeah. Well, no, I mean that it's all just run by just corrupt people.
Yeah.
They just want to control everything. It's just like
Pretty much.
it's very select that 0.5%, 0.2% of people that are like this super mega rich are controlling all of us.
Yeah. I mean, it said that in the video as well. I mean, the Fed doesn't disclose anything that they talk about, or we don't know how much gold is in, Fort Knox right now, supposedly. And a lot of people say there's absolutely zero in there.
I think China has it all.
I would not be surprised, for being honest. But yeah, no, there's it definitely gets interesting when you start talking about the Bill Gates and the Jeff Bezos of the world and kind of what they're trying to do and how they are trying to control our economy and work it to their benefit. Kind of one thing is through this whole pandemic, people complain about the big corporations and them raking in all the cash from
The PPP
from
loans.
the PPP and all that. But throughout the pandemic, how many of y'all went to Walmart or Target to buy something they needed rather than buying it off of Amazon? That was a big thing with the stay-at-home orders. We were forced to order everything online. We had to do a lot of our business and all that kind of stuff online. Well, I mean, in doing that, they kind of closed shop. They closed the mom and pop shops. Obviously, they weren't allowed to be in business, and that's kind of what resulted in these corporations. And I thought Jeff Bezos gained around $10 or $15 billion in net worth throughout the pandemic. Well, I mean, that was, you can be upset about that, but I mean, it was our own fault because we were forced to stay inside. and we weren't allowed to go, live life as we normally would. But we'll get back to talking about the FDIC. We're pretty much done though. These 2 points, it supervises the banks and thrifts for the safety and soundness, and then can appoint a receiver or conservator if a bank fails or a thrift fails. They will appoint somebody. Every branch that they insure, they'll send somebody to run it and try to, like a business executive, a past executive in the banking industry. They'll bring someone in to try to recoup it and bring it back. So we just don't have banks going out of business left and right, because that would be obviously terrible. And then the federal home loan bank system. Now this is very, this kind of goes hand in hand with the Fed. It technically is the Fed, but for home loans, they don't really deal with the cash reserves like the Fed does. It doesn't deal with how much cash is in the market, all that. It deals with the securities, of the member institutions and the ones that are within it. So the ones that would have those securities are the 12 district banks, and then it's patterned after the Federal Reserve. It has 12 district banks, and then what it does is it loans money and sets reserves through the housing security market. So technically the Fed, but just over into the securities market. It also has a lot of economic impact. It can raise and lower the interest rates on home loans, similar to the Fed. They pretty much work hand in hand with each other. They don't ever differ. They never disagree. They're best buds. So keep your eye out for the federal home loan bank system. And then it also provides a national market for the member securities, where they can be sold and bought off. But so after talking today and watching that video, in regards to, I'll bring this up first, and just kind of talking about value and stuff that gives value. Just some funny points that I brought up that I just want to talk about because I thought of them and I thought they were genius. So, anyways, if I were to tell you to take you back 2 years ago to March of 2019 and told you that in a year, the most valuable things that you can have are toilet paper. I mean, because I don't know if y'all remember that whole craze, but it was all over the national news, all over local news. Toilet paper. Toilet paper was the #1 commodity in the market. I had people. I was looking on my Facebook buy sell trade at the time, just wondering, like, holy cow! If I would have known I could be cashing out right now on toilet paper, I would have spent, gone and spent $1,000 on toilet paper, because people were selling cases for $150, when it's originally like 12. Obviously that's illegal and price gouging, but you take what you can get. You're gonna make a buck out here.
You want toilet paper or not?
Yeah, you want toilet paper or not, and if you're gonna send the contact,
not Walmart.
Yeah, no. And so yeah, toilet paper was insanely valuable a year ago, but today we're back to normal, and it's back to 50 cents a roll. It doesn't hold that value that does anymore. Another thing is Bitcoin. Bitcoin, or a lot of cryptocurrencies. Bitcoin is currently at around, I think, 54,000. Last time I checked, a little earlier. But 10 years ago, it was worth a couple hundred. I don't know if y'all know about Doge, or the craze going on in Doge right now. It's especially spiked up the past couple days. But me and my friends, one night we were talking about cryptos and all that, because we really believe that we're going to get rich quick off of one of these cryptos. We do a lot of research,
Let me tell you about 2 months ago.
Yeah.
I had $30 in there, and it spiked up to over $200.
In Doge?
In crypto.
Oh, in crypto?
And I cashed out real quick.
Yep.
So yes, I can see how that happens if you have quite a bit of money.
Yeah, and that's the thing, is we don't have a whole lot of money to initially invest, so we try to find the really small coins that are supposedly gonna just skyrocket. None of them have panned out yet, but we're still working on it. So going back to Doge and the value that we find in that, it was in January, about mid-January. We were talking, and my roommate came in the house and was like, "Hey, I have a new crypto. It's called Dogecoin. You'll need to hop on it." And this was kind of when the GameStop craze was going on, all of that. So I mean, we were messing around. I was messing around in the markets quite a bit, and Doge at that time was 0.08 cents. And so I was like, well, I'm gonna tap into that, buy a lot. I put $200 into it. And within about 3 weeks, it shot up a little bit, and I made like $200 off of it. So I doubled my investment, and I was like, okay, this is a fake coin. I'm hopping out. Well, so I sold all of it, took my 200 profit, and I was like, okay, that's cool. Well, it turns out, especially since Elon Musk has been tweeting about it, I don't know if y'all know who he is, but Patrick Mahomes has tweeted about it recently, Carlos Hyde, a lot of big high-profile athletes, and now the price of Doge is up to 56 cents.
2 days ago, it just shot up.
Yeah, if I would have held it, my original investment would be worth about $14,000 today. Which we were just talking, and I was like, oh, it's just another coin. I'm gonna make a little money, and then I'm gonna get out. So yeah, the next time I find a really good coin that I like it and I do some research on, I'm definitely gonna be holding on with those diamond hands in hopes that I'll be rich one day. So, but yeah, so people find the thing with cryptocurrency is it has no worth. Dogecoin cannot be. Unlike Bitcoin, Bitcoin's a little different because Tesla has started. You can buy Teslas through their dealerships with Bitcoin, so it's kind of gone to the level of prevalency that it is being used as a typical currency. Whereas Dogecoin and all these, there's hundreds of coins and there's new coins coming out every day, all the time.
There was a NFL player that signed this past offseason. He was the first player in history to sign it was a contract rather than just money. Mm-hmm. He had signed he got a couple million in cash, but I think it was $2 million in cryptocurrency.
Yeah.
He got paid in crypto. And it was the first non-money contract in the NFL.
Exactly. Yeah. And I've actually heard a story. I was watching a video, and a buyer made an offer on a house. It kind of pertains to a little bit about real estate. Made an offer on a house in Bitcoin, and the sellers rejected, and about 6 days later, the price that Bitcoin jumped up. It was one of the days where it jumped up 23%, and jumped from 10,000 or whatever is that to 17,000. So man, if they would have signed in, if they would have executed that contract and signed in on it, and they would have given them how many ever Bitcoin tokens that they were offering, they would have made just that much more profit on that house. So that's and that was crazy seeing that, people were starting to offer cryptocurrencies for real estate. That's wild to think about. It's no money. I don't know how you even go about taxing that through the United States since it's a decentralized currency. Yeah. I don't really want to know, but I just thought that was really something crazy to think about in talking about value and what we put value in and how we see value. It's always differing, and it's always fluctuating, and always changing. So kind of after watching the video today and learning a little bit about the monetary system in the United States, I was just kind of wondering and knowing kind of how interest rates fluctuate and how taxes affect the economy. Why, if you were in Biden's shoes, with the way our economy is right now, how would you what is the first step that you would take to solve the situation?
I don't know. It's
not up to minimum wage.
Not up to minimum wage.
Just don't do anything he's doing, and you'll be good.
Yeah, basically any of the changes he's trying to bring in for the economy stuff is, regardless of what you thought of Trump, he did have a really good economic plan and business plan. Yeah, he's a businessman. Yeah. He's gonna have that on. So I don't know why coming in and adjusting his stuff and that was one of his top his.
Well, I mean, historically, it's been historically Democrats. I'm gonna say there hasn't been an administration, like it said in the video, including Trump. I mean, a lot of his economic policies were very good and treated the United States well. But even Trump just kept compiling national debt.
Yeah.
There has not been a president in recent memory or in a long time that hasn't been able to, even out the balance sheet, which is the goal of any company. The goal of a company is to be profitable. But the goal of any entity or, just a regular typical family is just, keep that balance sheet even. Try not to go into debt. If you can gain a little bit of money, I mean, that would be awesome, obviously.
Do you remember at the beginning of his administration going into office, they were going to buy 2 new planes and it was going to cost them $2 billion apiece? And
2 new presidential planes?
Yeah.
Yes.
Wait, who are we talking about?
And he declined it, and he said, why don't we just fix the ones that we have, update whatever we have to do, and it cost them a couple million.
Really?
So
Oh,
he
Trump
said-
did?
Yeah.
Mm.
At the
Yeah,
beginning
most of
his
the others.
administration.
He's a businessman. He ran the country like a business.
Yep.
Yeah, so,
So he saved us a lot of money.
yeah, no, he definitely did. But, kind of one things that Democrats use is they do hike up taxes, but those hike up taxes, they quote unquote push back into the economy, creating jobs, and it's really their goal. I see you shaking her head in the back. The goal of raising these taxes is to be able to reinvigorate that money and to shoot it back into the economy and create more jobs, which allows for growth, obviously. So you're saying that you would not increase the minimum wage? No. Ms. Vito, I mean, what are your takes? What would you do in our current economic situation to kind of try to filter us out of it?
I would allow businesses to open and run like normal.
Mhm.
I would stop giving people money that don't deserve it, like the unemployment. People are milking it because they know they can get a job. I know people that are purposely working the unemployment system just so they don't have to go back to work because they don't want to.
Yeah.
And there's people that are milking like Medicaid and food stamps and all that. I feel like there should be certain requirements that need to be met and a lot of not inspections, but like you have to pass a lot of
regulation.
Yeah, to be able to receive it because people are abusing it, and that's where a lot of the debt is going to. And everybody should be able to pull their own weight. I understand there's people that are mentally ill or physically unable to do certain jobs. Okay, I understand you getting that kind of assistance because you physically can't. But the people that can, that are over here having all these kids with different baby daddies and milking the system, those are the people that need to get their butts to work. And no, there should not be an increase in the minimum wage because all that's going to do is that people that get paid $15 an hour now work their butts off. They work hard. These are like construction workers. These are oil field workers, and they're working their butts hard. There's people with degrees that get $15 an hour. It's not okay for somebody that is flipping burgers at McDonald's to make the same amount of money, pushing those people that are up here making a decent living down here to the poverty level, below poverty level, and there's no way that those people are going to be able to recuperate the difference in pay. So everybody's just going to be at poverty, and they think that everybody's going to be living an equal life. Well, no, that's also going to increase the standard of living because now everybody's getting paid $15 an hour. So now the cost of milk is going to go up. The cost of gas is going to go up. Everything is going to go up, and everybody's going to be equally screwed.
All right, there you go. There you go. You got one take right there. Full-fledged of what she would do to fix the economy, and everything. All the math added up in my book. Sounded right. So
You should just run for president.
yeah, be it for president. Be it 2024.
Oh, that's weird.
Do it.
I wish I could. I wouldn't be old enough.
Okay, we'll beat it 2028. I'll be
the first game up with it.
He did 2028.
Yeah, I'll be your marketing director. And I don't know. I'll be somewhat. I'll be a background guy.
Yeah.
But Yeah, I mean, with Vita's great explanation there and kind of what she would do, there's a reason we go back and forth administration-wise and who we vote. Nobody can really nail that right answer. Nobody can really nail this is the key to get us out. This is how we do it. It's always fluctuating.
Can't please everyone.
Yeah, I mean, you're never gonna be able to please everyone.
I wonder what it would be like though, where it could just stick one way for, like whether it was Republican or Democrat, just stay on one path for a while just to see who this would actually would work out.
See what happens.
Yeah. But at the same time, I don't want to do it wrong.
Yeah, choose the wrong way.
Yeah, no,
then you run with it for a long time. Yeah, then you kind of.
Or just have it like going both on like one half.
Yeah.
One half. See which one goes back.
Trying to do with the Democratic Party right now. They're trying to, pack the court by adding another justice that would be a Democrat. So now there would be a justice in the Supreme Court. There would be a legislative, the legislative branch would be Democratic. Like all three branches, judicial, legislative, and executive, will all be Democratic. And every decision they make is going to go their way.
Yeah.
So anything a Republican will say is just going to be out the door. And it's not just because Republicans are right, because they're obviously the right party. Good. But no, like there has to be checks and balances.
Yeah.
Because there's some things that one party's going to do that the other party's not going to favor, and they have to check each other. But the way they're trying to do it right now is they're trying to hack the court. So right now, they have two branches and they're trying to get the third one. And if they do, it's going to be pure chaos. Like legit.
Yeah. Yeah, I think that is crazy. That I did see that they were trying to add 4 more justices to the Supreme Court to bump it up from 9 to 13.
Oh my gosh.
Yeah, it's pretty wild. Pretty wild proposal. But just kind of going back on everything, there is no right answer. If you totally wipe student loans, the people who have worked hard and saved up and paid their student loans off, they're going to come right back at the government. Not only are we going to wipe away, hundreds of millions of dollars of student loans, well, then the people who have paid their loans are going to come back and say, well, I want to be reimbursed for what I had to work and pay back. So then we're going to have to, if we're going to keep it equal all the way around, we're going to have to dish out hundreds of millions of dollars more to those people to make them happy. And basically what I'm getting at is economics, financial wise, there is no right answer. We're always going to be kind of in this teetering back and forth cycle, and that's just the way it is.
Like even in those old days, there was no way that you would have been able to survive if you did not pull your weight.
Yeah.
Like the way they were talking about the bartering. There is no way that you're going to survive if you did not either farm animals or plants or make something that benefited somebody. You can't just live for free. Everybody has to do something to be able to, benefit another person. Because, I might, herd sheep, and this person over here makes vegetables or whatever, and this person over here builds houses. Well, I need those vegetables because I need it to have a balanced diet. I also need this person's expertise in building a house, and they need my sheep. But I can't just be like, hey, I've got nothing to offer you, what you gonna give me? Nothing.
Yeah.
And that's what they're trying to do here is everybody's like, oh, I don't want to offer nothing, but I want you to give me everything.
Yeah.
And that's where everything is thrown off balance.
Yeah.
I agree. We started with everyone gets a trophy, and now we're
Started in Little League. That's what
Here we are. But yeah, that's gonna wrap up and conclude the lecture for today. Again, I'm sorry to bore y'all and make y'all watch that video. But as you can see, these slides are pretty bare, and I don't want to just be talking to you the whole day. I'd like to provide stuff that you can, kind of watching that you'll get, a different perspective on everything, information-wise, and I'm sure you learned quite a bit from the video if you're able to pay attention. It is very informational, informationally packed, and a good video. Yeah, that'll pretty much do it for us today. Does anybody online or anybody in person have any questions, comments?
Everyone good online? We good?
Everybody online, good?
All right.
Alrighty, sounds good. Well, you all have a good evening and we'll see you tomorrow.